talking this morning on FNC's Morning View about indexes, and we're talking about why people want an index, what types of indexes are out there, and what about our index, the FNC index. So let's sort of back up and talk about why you'd want to have an index anyway.
Well, people want to know which way the weather's going. You know, they want to know if it's going to be sunny or if it's gray. You know, it's not sufficient to look out the window. You've got to have someone telling you what the index is going to measure. So,
or you want to know what prices are doing, as in the consumer price index, or you want to know what anything, how it's going to move and how much it moves. You want it quick and simple and easy to understand.
Exactly, and
housing price is no different.
That's totally correct. But everybody knows that housing prices are different. Okay, the weather is different in every part of the country, but you take an average over the whole country, and so, but basically, I mean, that's a valid question. Everybody wants to know: are houses going up in Boston, or are they, are they still going down in California? They would like to be able to measure it, and even though we know that one neighborhood might not be the same as the other one, they want a general measure of that.
And they don't want to spend any money to get it, basically.
Oh, of course not.
They want it inexpensive, they want it fast, they want it, in the end, because of the internet, they want it at their fingertips.
Right.
And so let's talk, so I think most folks can understand what the attractive nature of an index. If you're in the financial community, an index has many applications on housing. One of the things you'd like to know, if you're the holder of a mortgage, is what was the true value of that mortgage when it was of the house, underlying house, when the mortgage was originated. What's the value today if you're trading it, and what's the value going to be, say, up to 2 years in the future? It's hard to do that, predict that without an index. Now, you can use an index to describe markets in a generic sense, and you can also use an index to predict what's going to happen. Right. So let's talk about the models that are out there. We hear a lot about Case-Shiller, we hear a lot about FHFA. Talk to us about those and that sort of thing.
Shiller and Case were our professors, and many years ago, when they were trying to come up with an index to measure housing prices, they looked around, and the trouble was that there wasn't really good data about houses. I mean, as we all know, the thing that determines the value of a house is where it's located, which neighborhood it's in.
There was good data that was just inaccessible. It was in appraisers' hard drives, and it was in multiple listing services. You just couldn't get to it.
Yeah, you certainly couldn't get to it to do a model. But I mean, how many bedrooms? How big is the lot? All of those types of information just wasn't available. So they did a very innovative way of approaching that. They said, okay, well, let's not worry about what the house is made of or what features it has. Let's just look at how the same house changes price over time. So they would take a house that sold 5 years ago, say for $50,000, and they looked, and now this last month it's sold for $70,000. So that means that over that period of time it's increased by about 40%. And so therefore they would look and say, okay, if all houses increased by that same amount, then we would be able to compute exactly what the pricing changes over time. And they do this, they collect all the houses to sell in the current period, all of those that have sold previously where they knew the price, right. Then they would be able to create those ratios and come up with an average change in price, sort of an average inflation. And
the literature has looked at, people have tried to disaggregate a house into price per square foot and how that's changed over time. They looked at absolute prices.
Right.
But there's a lot of differences from house to house. In other words, there's an assumption that the price trends in a given market are the same for all the houses, basically, on a sale and resale.
Exactly. And there's, I mean, they recognized when they did this initially that there were a lot of limitations.
But they did the best data they had. It was
the best they had, right? And so one of the assumptions, obviously, is that the house hasn't changed at all in that time from the prior sale. So that the only reason that the price has changed is simply that that there's been inflation. So the neighborhood hasn't changed.
School district hasn't changed.
School district hasn't changed.
No additions.
No additions, no modifications. Everything is, and it hasn't aged.
Right.
Right.
And like us.
Yeah, exactly.
Okay.
And so that's the assumption. And then the other issue is that because there are not very many houses that sell, in any given neighborhood, you have to go out to a broader and broader region to get enough house that is to actually compute the index.
Compute a return.
Right, and so what they often do is go out for the whole MSA, and then that's generally not enough data either, so they go for 3 months, and so they average it over a 3-month period. So that's a big area. So in California, for example, in LA, you've got Compton and you've got Hollywood area, you know, both in the same MSA, but their behavior is totally different.
Radically different markets. And then once they get a macro model for the MSA, they will disaggregate and estimate then at a...
They can try and do that, but you know, it depends on how much data they have.
Right. At a granular level.
Exactly.
Now, FHFA's model is a little bit different.
Right. They're looking at the actual houses that come in on GSE loans.
Right. They're the regulator for Fannie and Freddie.
Right. But the methodology is identical. If you go to their website, they talk about using that exact same methodology.
Just for a different data set.
Right. Different data set, conforming loans.
Right.
All right. And then there are several other companies out there that have similar repeat sales indexes, and they try to improve them and modify them. Sometimes they'll use listing data, sometimes they'll use other data that they might have to try and improve it a little bit. But fundamentally, it's all the same type of model.
So to build this model, basically we're looking at sales and resales of the same house over a period of time in a given market. And for FHFA's model, we're looking at the same methodology, but only for GSE loans, and those GSE loan limits have changed over this period of time because they went up and back down.
Exactly.
So you get some inconsistencies because of that.
You know, and the number of properties that actually trade is very, very small. In the LA market, for example, the LA MSA, it's only about 2% of the properties in any given year that have a prior sales price. There are two factors here. One, new construction can't be in the index, right? Because there's no prior sales price.
Previously, right?
Exactly. And the other thing is that public record data often is very limited in terms of recording that information.
Right.
And particularly in some markets, there's very little public record data. So you just have a very small, very tiny amount of properties that you can actually use.
So let's shift now and talk about, these are the models that are out there. The literature is very clear. Hedonic indices are clearly preferred because they take lots of data, but they capture quantitative and qualitative aspects of valuation issues.
Right. If you're creating a model to describe what this house is going to be worth, what you would normally want to do is to say, okay, let's look at tens of thousands of houses and try and figure out how people value the different pieces of that house. Okay, how important is additional square footage? How important is additional bedrooms? How important is a pool? How important is this location versus that location? And you pull all those things together to create a model and an estimate of the value of that house.
And it may not be just how important is 500 square feet, but how important is 500 square feet given the fact you already have 2,500 square feet in the neighborhood.
Exactly. And, you know, people's preferences change over time. I mean, styles of houses. People, you know, all of a sudden everybody wants this kind. What?
Do you have an A-frame?
Oh, I still live in a geodesic dome. So
under the ground.
Exactly, yeah. But, you know, all of those things are important because those preferences do change over time. And, you know, family sizes change over time, so the demographics change over time. As the baby boomers start wanting smaller houses, the demand for those goes up. Those preferences change, and you have to be able to reflect those in the actual models.
We'll talk about our model. The website is FNCRPI.com.
Right.
And talk about our model, our residential price index.
Our model is, we worked for many years to get enough data so that we can actually create a model based upon those physical characteristics.
Enough appraisal data.
We add appraisal data to public record data, so we have enough data, so we have those characteristics, and that allows us to create that kind of a really detailed, refined model based upon each of the characteristics of the property. That also allows us to use all of the housing stock, so we're not limited to go out to an MSA and a 3-month. We can look at a single month, and we can look at all the houses in any given area. So we can do an index, for example, on a zip code, or a census tract, or we can look at water view properties, or we can look at properties in a school district. Any way you want to categorized.
So if I had a portfolio, to make this real, if I had a portfolio, you could take an index and you could tailor that index specifically to my portfolio and see how my portfolio changed in value over time.
Exactly. We could use the specific houses in that portfolio to create an index just for that portfolio.
Well, the word for that is fantastic. This is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey, and we hope all of you all have a fantastic day.